Hey traders, this is Blake Morrow with Traders Summit, and I have Jim Welsh with Macro Tides. It's Friday, so we do a nice little roundup every week with Jim and kind of get his input on the markets, how the markets have responded to some of the macro influences, and also with a technical view as well. So welcome back, Jim. Good to see you.
Always good to be with you, Blake.
All right, and remember, guys and gals, if you're watching this on YouTube, make sure you give Jim a thumbs up, subscribe to the channel so you don't miss any of his recent commentary. And like I said, we do this once a week on Fridays, and it's always nice to meet with you. So Jim, we've had a lot of activity in the markets, and I know you brought some charts for us to take a look at today.
Yep. But
before I go into that, I gotta ask you this question. Was that it today or this week? Do you think the S&P, and I know you brought an S&P chart, but do you think that the markets have peaked this week? Markets peaked this week near term?
Well, definitely short term, a peak. And as we talked last week, and as I wrote about in Monday's weekly technical review, my expectation was that we would see a little bit more strength and then a pullback. And it's really how deep this pullback is and what happens on next rally attempt that I think will really define the outlook for the next several months. So the next 2-3 weeks, I think, are going to be pretty important in terms of the information that's provided.
Okay, well, I'm really interested to see your charts that you brought, and one of the first ones that you brought here. Let me go ahead and bring this up. You actually talk about a soft landing that the Fed Chairman Powell is alluding to, right?
Right. Yeah. 2 weeks ago, he gave a speech to the National Association of Business Economics, and he kind of touted the Fed's prowess at creating soft landings. So I went back into 1947 and looked at the 14 instances where the Fed was raising rates, and lo and behold, the only 3 soft landings there ever were in the years he cited. But 3 out of 14 get you a batting average of 214. So any team that would have a winning percentage of 214, I don't think their fans would be glowing about winning being a common experience, which is how he phrased it. The I do in the April issue of Macro Tides, which is going out today, is review those 3 instances, Blake, and compare them to what's going on now. And the challenge facing the Fed today is much more daunting than in those 3 other cited examples. So to me, this is the risk. Now, what the key thing here is we won't know this until we get out into next year some point in time, because as the Fed raises rates, there's a lag time between them acting, the prime rate going up, and its impact on the economy. So to me, the whole thing about recession really isn't a realistic discussion until we get out to next year. So.
Okay. Yeah, that's fair enough.
Yeah, the second point is that the Fed will use its tools to moderate demand growth. Well, basically what the Fed is acknowledging, we can't improve supply, but we can diminish demand. And what does that mean? That means we're going to see the economy slow. And as we get evidence of the economy slowing, the Fed's going to continue to be leaning to raising rates, shrinking its balance sheet. And so I think somewhere out there in a few, somewhere within the next 6 months, there will be kind of a recession scare. So these are the hurdles I think the equity market has to face. Everyone's jumped on board. Hey, the Fed says they're going to get a soft landing and they want to believe it. The batting average on that is quite low. And in the meantime, we're going to be faced with progressively weaker economic data points. Obviously, today's employment report, is good, but it's a catch-22 because Powell has noted that the labor market is extraordinarily tight. That means higher wages. That's a good thing, but that means you get more demand. So again, I just think those are the hurdles that the market is going to have to face. And to me, there's 2 things. Either we're going to get another push higher in the S&P, or we're going to new lows. And we can look at the chart of the S&P to kind of break that down more definitively. But first, we got another chart to look at, or thing to look at, which is good. So this is small, I'm sorry, but Ned Davis did an analysis of all kinds of Fed tightening. Oh, that's beautiful. Way to go, Blake. And he differentiated between gradual rate increases and accelerated increases. Now, historically, prior to this outcome, the Fed would raise rates in anticipation of inflation. So you'd get gradual increases at the beginning of the interest rate cycle. And I believe this chart goes back to 1955. And what the Fed did in 2018, as we all know, is they shifted their policy approach to, we're going to wait for inflation to show up before we raise rates. So they're behind the curve. And, Powell has laid out, obviously, a pretty aggressive and accelerated process of tightening. So if you look at this chart, you can see the red line is from the first rate hike going out 12, 24 months. The the turquoise line is gradual rate increases. And you can see, hey, in the year after the initial gradual rate increase, the S&P did good. Again, part of the context is that the Fed was starting early, gradually raising rates. The economy was still growing. And so no wonder the S&P would continue to go up. If you look at the lowest line, which is the light blue line, those are accelerated cycles. You get a completely different outcome. The Fed's behind the curve. They're raising more aggressively. The S&P holds up for a while, first 6 months, and then it weakens. So to me, it's clear that we are in an accelerated rate hiking cycle. Plus, the Fed is going to taper its balance sheet, which I also discussed in the April letter. So to me, the S&P has some real challenges, and the willingness of people to really overlook the probability of a soft landing and the fact that monetary policy is going to be much more aggressive than most people have seen. I mean, the majority of people in our business, Blake, have been in it maybe 10 to 20 years. No one has ever seen these circumstances. And I think that's partly why people have such a sanguine outlook. And I'm not sure that's completely warranted.
And so, Jim, if you want to just ignore everything that you said and just close your eyes and hope for the best, you just look and say, I'm just looking at the orange line here. That's it.
Yeah. Yeah. That's the average. Well, that's the average.
Yeah, that's the average. Right? Okay. All right.
But again, there's been more gradual cycle because of the way the Fed used to operate versus accelerated cycle. So you're going to get a natural lift. Plus, in those gradual cycles, the S&P did have a better performance.
And let's not forget that the stock market is at all-time highs. We've gone through rate hikes and rate hikes and rate cuts for since the beginning
since 1913,
and stocks have always continued to climb. So that's the one thing I want to put in the back of everybody's head. All right. So what else? You got a picture of the S&P that you wanted to bring up next, correct?
Yep.
Okay. Let's take a look at the S&P. So here we are. You were talking about initially we were going to go down below towards 4,100, maybe slightly below before rallying, but the market just basically did an about face and just went straight up. So
yes.
Now we technically made a higher high, broke above 4,600, but here as we were wrapping up the week, at the time of us filming, we are at the lows of the session. How do you feel about equities here?
Right. Well, a couple of things. Last week we went through a longer term chart of the multi-year chart of the S&P, and the context I've been operating under, and I've been very consistent, is that we were going to get a pullback in the first part of this year that would be wave 4 off the March 2020 low. And that whatever this correction was, it would then subsequently be followed by a rally to a new all-time high. That has not changed, in my opinion, okay? When we were down near 4,200, I noted in the weekly technical review, hey, we were due a rally. The rally was bigger than expected. I thought 4,460 was the original target. Now, obviously, we've extended well beyond that. The point I raised last week, though, Blake, is we're at a crossroads. Either the low at 4115 in late February is wave A of 4, and this is nothing more than a big ABC rally up for wave B of 4, and then we're going to see a decline that takes the S&P down. That's one route. And to me, some of the fundamental stuff we just talked about is kind of supportive of that outcome. The other outcome is, hey, the bottom is in. We've had, instead of A, B, C, we've had 1, 2, 3 up to the high a few days ago. This pullback is a 4. And then we're going to see another rally over the next few weeks that takes the S&P up to maybe 4750 or some number. Main thing is you get 5 up. And that to me would then mean that's wave 1 of the rally to new all-time highs. But what happens after wave one? You get wave two. And given the economic fundamentals that we just discussed, I think you can get a pretty deep retracement of wave one. So if the S&P, just to make the number simple, goes from 4115, tops at 4715, rally of 600 points, a 382 retracement is about 200 S&P points. A 618 would be 360 S&P points. So my point is, I think we're going to see the S&P pull back to below where we are during wave two. And that will provide a much lower risk entry point, because I will have more conviction that, hey, we just had 5 up for wave 1 of 5 to new highs, wave 2 pullback. Now we're going to really zoom higher. So, and the alternative is obviously we go to lower lows, and that'll be the buying opportunity.
Okay, so I was going to say that so it still is possible that we see below 4115.
Yeah.
Okay.
What would lower that outcome is if the S&P pulls back to, let's say, 4450 in the next handful of days, and then rallies, as I said, over 4700. So you can say, wow, that's instead of ABC, it's 1, 2, 3, 4, 5.
Yeah.
That, in my opinion, confirmed that the low is in. And now we're just going to get a wave 2 pullback. But I think that wave 2 pullback could be pretty deep. And so the trade location right here is not favorable. You might have a little bit more upside, but potentially you got to drop to new lows. We just don't know. At least I don't know. Okay.
Yeah. Okay. All right. Fair enough. And last week you talked about the TLT. This week you bring it back up again. Here we are, and we did hit new lows, as you were.
We did. And then what's interesting is today, I don't think this is the chart I sent from today. So maybe I screwed up and sent you the wrong chart.
Oh, okay.
Because if you look at TLT as of Friday, we got a huge jobs employment report, unemployment rates down, job growth up, in terms of wage growth. So anyway, what you look at is there was a spike down in TLT this morning in reaction to that news, but it's been clawing its way back. So again, to me, sentiment has become so negative, and we're starting to see some of the momentum indicators turn. And again, I got stopped out, but I still think that my point in my Monday letter was, I still think we're near a low in Treasury yields, and we're going to see a rally in Treasury yields, which means, Treasury bonds with yields actually coming down. And today's reaction in the bond market, in response to this news, I think is supportive of that outlook. And I apologize for sending the chart from, I think, last week instead of.
That's okay. Here's the.
So you can see how we went down, we've made a lower low, and now we've bounced. And, it doesn't mean there can't be another retest and all the rest. But to me, the aspect of the bonds are rallying in the face, what should be really pretty negative news, implies that market is pretty well sold out. And sentiment is really, really negative. So if I'm right, and we see more signs of the economy slowing in coming months, which I think we will, that's going to be supportive of bonds. Plus, there's a lot of risk out there still in terms of what's going to happen with Ukraine. And I just think there could be another event risk that drives a flight to quality, if you will, to Treasury bonds.
All right.
So, reward standpoint, I think bonds are pretty well sold out. And I still think TLT can rally towards the 138 to 140 range.
And that would give us some relief in yields then.
Yes.
The next chart that you brought over, this is the dollar index, right?
This is the dollar index. And as I noted last week, there's still the potential for the dollar to have one more spike up towards 100. It's been going sideways. It looks like a triangle type pattern potentially is forming here. That would be wave 4. You get a spike up towards 100. I think that completes the rally from the lows of a few months ago. And my expectation is once this rally is complete, we'll see a pullback to the 95, 96 area. So as long as 97.71, which has been kind of the low you see on that chart, holds, the door is open for another spike up in the dollar index.
Okay, and that means that the euro might have something to say about that, right? So let's
we noted last week that, okay, the euro came down to a multi-year trend line when it got down near the 109-ish area, 108, and the rally is very choppy. So that implies that there's a dip below, I think, 109 coming on that spike. But my take here is that ideally what would happen, Blake, is if the dollar made a new high and the holds above its high, then you get what it's called an intermarket divergence, where one aspect of a market is, in this case, the dollar making a new high, but the euro isn't making a lower low. And that's the kind of divergence that also often sets up prior to, intermediate lows and good trading opportunities. So to me, I would be looking for an entry to go long the euro on any spike higher in the dollar.
So just to make it, to simplify it for our traders at home, if the dollar index hits new highs, the euro, maybe trades down to 108.50, that might be a level you want to pick it up as long as it doesn't hit new lows, right?
Yes.
Great.
Thank you for defining it so clearly.
Yeah. So, well, divergences are, traders' wet dream, if you will. Did I?
Yeah, I know.
I did. All right. Well, Jim,
it's Friday. We all deserve a wet dream. No,
I guess we do. Well, I want to thank you for joining us and blessing the Trader Summit community with your analysis and your overviews of the market. So, how do you find out more about what Jim does on a daily basis?
The easiest way, because I'll send you some information, some sample letters from recent past, Jim Welsh Macro at gmail.com.
Okay.
And, that to me, the best way for people, read some of my stuff, my analysis over the last month or two, and that I think will provide you a lot of, hands-on information.
All right. Sounds great, Jim. Well, I appreciate you, and I'm glad that you had joined us once again this Friday. I'm going to look forward to our next talk. Well, actually, we're have a big annual event, and if you guys haven't signed up for our annual event, it is going to be next Friday. So, Jim, unfortunately, you and I aren't going to meet, but there's going to be so many great speakers. We have Danielle DiMartino Booth, Jim Rickards. We have now Peter Schiff. We have Mark Minervini. I've got so many of them in my head. But you guys check out.
Well, collectively, I would say those people combined probably overshadow me.
It's gonna be a really, really cool event that everybody should register because it's free.
Yep.
And you can get to that in the link down below in the description of this video. So, Jim, we'll see you in 2 weeks.
A couple weeks.
And thanks for joining us today.
Have a good one. Take care. Stay well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.